So we're reviewing the 2016 paper. So we'll start with question number 1. Question number 1 reads, Wangi and Company, a construction real estate company incorporated in Zambia. They've been in business for 15 years and are considering venturing into a Mauritian market. And they've approached you, advise this company on the particular risks that they will be faced with if they decided to do business overseas. But B suggests why a private company might go public. So this is foreign trade or international trade, and also company structures or company organizations, unit 1. So this is a 25-mark question, which requires a lot of theory. So to start with, when venturing into a foreign market, you need to understand that there are risks that one institution must come up with. So here are some of the potential risks. Number 1, the regulatory and compliance risks. So we know that each company has its own set of regulations. So compliance requirements for such businesses are inevitable. So the company must familiarize themselves with what? The laws that are in that particular land. The laws that are in that particular land. What other risks do you think are there?
Risks that could be faced would be foreign exchange risk or currency risk.
Okay. So we have currency risks. Yes, what is associated with the currency risks? So going into another country would bring in currency risks. That's true. The fluctuation in the currencies. We also have cultural or social risks. We also have political and economic risks. We also have market risks. We also have operational risks. We also have legal risks. These the different types of risks that you will need to find yourselves with. Okay, these are inevitable risks that are there. So let me just expound on each of these risks so that we could understand further. So when we're dealing with regulatory risks, basically, we're looking at the fact that each country has its own laws and compliance requirements. So Wangi and company will need to familiarize themselves with the Mauritian laws regarding construction, regarding real estate, regarding taxes, FDA. So non-compliance will result to penalties. So we wouldn't want to have such risks. We also have what are called social and cultural risks. These are to do with the differences that emanate from the cultural differences. So the impact can be on the business operations and the relationships. So Wangi and company may face challenges regarding understanding the customs in Mauritius, the communication constructs, the societal norms. So these risks are supposed to be analyzed. They will also have what are called political and economic risks. So these are to do with political stability or changes of government. So these policies can affect business operations and investments. And as such, it is important that they have to be aware of the government structure, the political landscape. The other risks that are probable are factors such as economic factors like fluctuations, inflation rates, currency, like you mentioned, market volatility. So these ones impact the profitability and sustainability of the company if they're to venture into a company in Mauritius. So we also have operational risks. Operating in a foreign country can pose logistical challenges like sourcing of materials, hiring of local talent, and also supply management. So this company should also consider the costs of establishing in outsourcing such operations in Mauritius. Then we also have what are called contractual legal risks. So where there are contractual disputes, and intellectual property issues. So legal proceedings may arise. So you need to study the legal risks that are there, so that the company should seek legal advice and advice on such agreements. So these are the probable risks that Wangi and company is likely to face. Okay. Any questions at that point? So why should a private company seek to transform to public? What are some of the reasons why a company would want to go to public? Can you give me reasons why? Why would a company seek to go public? So there are many reasons why a private company would want to go public. Some of the reasons are, number one, aspect of access to capital. We know that private companies going in an IPO allows it to raise funds. A private company can only raise funds using family, friends, but a limited company can sell their shares on a stock exchange. So they will allow them to go through what is called an IPO to allow the company to access huge sums of funds which are needed for expansion. The other issue is the liquidity for shareholders. So when traded publicly, companies become more liquid, especially the shareholders, meaning provides them a platform for buying and selling shares at the stock exchange. So the liquidity can increase to attract the company's stock to investors. So also the enhanced profile and prestige. So being listed on the stock exchange enhances the company's credibility. So it will attract the media and attention from other probable investors. Also for currency acquisition. So publicly traded companies use their stock for acquisition of what? Of currency. They will allow them to pursue growth opportunities and through megas and acquisitions, and also other than relying so much on cash or debt financing, they'll use those shares. So also employee incentives. So public companies can offer stock options. So sometimes in issues where employees want to become shareholders, they'll give them what are called stock options, where um, giving them compensation packages can come in terms of being owners. So this will attract and retain talent within the company. So sometimes you discover that some of the employees know the company too well, other than giving the company to outsiders. You give them. It's only a public limited company that can have such incentives. Are we together so far?
Yes, we are.
Also, we have exit strategy for investors. So it's only through public companies that there's an exit strategy for early investors or venture capitalists or private equity firms that are looking to incentivize their investment. So by selling their shares on the stock market, investors can realize their returns on their investments, and they can have exit options. Okay, so these reasons why a company would want to go what? Would want to go public. So this is where the 10 marks are coming from. Any other reasons? Let's go to the calculations. I want us to okay, question number 4, the third part here. Question number 4, that's this part here. Okay, combining 2 or more assets in an investment portfolio will lead to diversification benefits. Combining 2 or more will lead into diversification benefits. So what are some of the advantages of diversification? What are some of the advantages of diversification? And what are the general conditions under which diversification could have benefits? Ida, how would you attempt that question? Have interactive classes. Matimba.
Oh, sorry, Collins. I couldn't unmute myself. So I think one of the benefits would be, I think it reduces the risk in that you're able to probably spread your investment across, multiple areas.
That's correct. Okay, diversifying key purposes mainly to spread your risk amongst, so spreading of risk. What else is the reason? Let's participate before I come in. Diversification. Remember, sometimes most of the questions that come predominantly include theoretical questions. So I need you to really give understanding of this theoretical question paper before we go into the calculations. We're looking at question 4A and B. Able to see the screen?
Yes.
Okay. So we're looking at A and B. They've given one answer. So let's continue. What are some of the benefits of diversification? And what is a general condition under which diversification will have benefits? So those two are what we're answering quickly. Let's move quickly. Do we understand what diversification is?
Let me give it a try. Another benefit of diversification. I think it also helps to increase one's revenue in that you're not relying on one single source of income.
Okay, that is also so let me quickly talk about them. Number one, diversification ensures risk reduction, like has been talked about. So you spread investments across assets to help reduce the impact of a single poor performance. Smoother returns, diversification will help you balance up the ups and downs of individual assets. So this will lead you to a more stable return. So diversification will also help in preserving capital, because when you diversify a portfolio, it will protect against significant losses. It also enhances consistency. When you diversify, it will lead to more consistent performance over a long time because you're able to balance up. Exposure to multiple opportunities. When you diversify in a number of investments, you're going to have different market opportunities. So you'll benefit from each of the sectors. you also hedge against specific risk. In diversification, you allow investors to hedge against specific risks that are associated with an asset. You know, there's market risk and specific risk, or systematic and unsystematic risk. Also, you have potential for higher returns because when you diversify, the primary aim basically is to reduce what? Risk. Okay, so there are many reasons. So basically, I will need you to navigate around these many available options. Okay, so these are just part of the many that we just, so reduction of risk, smooth returns, consistency, hedging against specific risks. Okay. So we've talked about all these. I hope they're making sense. You also have adaptability to changing markets. When you diversify your portfolio, not every exposed market conditions are susceptible to. Right, then the other part of the question was asking us why, under what general condition does diversification have benefits? Briefly explain why. Okay. I repeat, what is a general condition under which diversification exists, and briefly explain why. So diversification generally exists under the following conditions. So diversification will generally exist under, such as generally to provide benefits when assets in a portfolio have a low or they have a negative correlation. That is a condition. So this means that they are not moving in perfect synchronization. So when asset performs poorly, another asset performs well, it will help balance. So diversification makes sense when there is that mix. If all of them are doing fine, continue with them. But diversification basically arises from the fact that assets with low or negative correlation will tend to respond differently to the market conditions. So when combined in a portfolio, these assets will help to cushion against these losses in one area and gains in another. This will lead to overall reduction without sacrificing some potential gains. That is why we would want to do diversification. Okay. Are we following? Let's go to question number 6. Let's go to question number 6. And question number 6 reads, debt finance is another source of long-term capital for companies. So discuss 3 examples of debt finance that are available in relation to a company. Okay, so let's start with part A. What are any 3 sources of debt finance that you know of? Brenda?
A loan.
Yes, loans. What else? Bonds.
Bonds and debentures.
Debentures, correct. Okay. So these are the 3 types. Can we expand on them? But expand briefly on them and how they are long-term sources of finance. So we can say the following. So bonds basically are secured securities that are issued by government or corporations to raise capital. Typically, they have a fixed interest rate with a maturity date companies can issue corporate bonds to investors, promising to repay the principal along with periodic interest. So loans also are obtained from financial institutions like banks or credit unions. These loans are secured or backed up by collateral. There are also unsecured loans, which are based on the company's creditworthiness, and loans will provide a lump sum amount of money to be repaid over a certain period of time. Debentures are unsecured debt instruments that are issued by companies backed by companies with creditworthiness. Typically, they can offer fixed interest rate and are repayable at a predetermined time. So other debt sources, although we just asked for three, would be convertible bonds, commercial papers, revolving credit facilities. So these ones, for those of you who can add to your flesh if you understand them better. So convertible loans offer flexibility to convert the debt into equity. Commercial papers, these ones are short term, but unsecured promissory notes issued by large corporations. Yeah, but convertible bonds are the ones you can add to that list of the long term. So let's go to the next question. Next question is asking for, in relation to a company sourcing capital, discuss the benefits of using equity as finance. Okay. In relation to a company sourcing capital, discuss three benefits of using equity. So can somebody talk about the benefits of equity or shares? The benefits of using shares in financing, Brenda? Equity. So there are several benefits that we could have. So benefits could be as follows. Number one, there's no obligation for repayment. Equity does not require the company to make periodic payments because they are owners of the businesses. Shared risk. The advantage is that investors here, they share the company's risk and also the rewards. Permanent capital. The capital is invested indefinitely until at a time when somebody wants to opt out, they sell to somebody else. Enhanced cash flow, unlike debt, this kind of financing structure has fixed interest payments that come in form of dividends. So the equity finance does not impose cash flow burden to the company. There are certain times when the company is not doing fine, they'll not pay. Increased borrowing capacity. So leveraging on equity alongside debt, companies will improve their debt to equity ratios. So this is an advantage of using equity. There are several other advantages that you'd want. Only three were asked. You would choose to research more on, but I'll quickly just add on these. So strategic partnership, equity investors bring valuable expertise to the table. Okay, so not only is it in monetary forms are expatriates who are equity, because if you're an owner, you also want to bring suggestion on how the firm must be run. Flexibility in capital structure. Financing using equity gives greater flexibility to the company structure. It allows management to tailor a mix of equity to debt to suit the company's objectives. Attractiveness of talent. So offering equity participation through employee stock options or equity grants can attract to retain the top talents. Also, valuation enhancement. Equity financing can enhance the company's valuation, signaling confidence of growth. Alignment to interest. Equity investors have vested interest in the company's long-term success, so they'll align incentives to ensuring that they foster accountability, transparency, and focus on shareholder value creation. So these are many of the advantages that you could look at. Are we together? So I repeat, those of you who have a stronghold or who are weak at calculations, I'm trying to give you an opportunity to do what? To maximize on the theoretical part of it. So part B, are we together so far?
Yes, we are.
All right, so part B is saying your wealthy industrialist brother is trying to persuade you your retired uncle to buy shares at CEC. Himself owns a few thousand and is impressed with the steady price rise. Your uncle is skeptical because CEC pays very small dividend. What are your arguments to make your uncle purchase, and what are your arguments valid in this case? So what are your arguments? What arguments is your cousin likely to make for your uncle, and are the arguments valid? So your uncle has asked for advice. Do we want to participate in this? So now these are some of the prospects that you may be given to your uncle in investing in CEC. So number one, you talk about obviously the growth potential, the stability and reliability of investing in CEC, the dividend policy, which is one of the topics that is coming, the portfolio diversification, and the capital gains. So these are the 5 key areas that perhaps could be valid to coerce an investment. So let's go to these points in depth. So when you are looking at investment or buying shares in a public company like CEC, so you're going to give a prospective client the following key points. Okay, number one, the growth potential that exists. So CEC may not really offer high dividend payout, but it has shown that there has been consistent growth in earnings per share. So this will suggest that the company keeps reinvesting profits for expansion purposes, which is not a bad idea to lead to future capital appreciation of the stock. Secondly, the stability. CEC operates on a very stable industry platform, providing electricity transmission to services, especially at the time when we have load shedding. So the business model is relevantly resilient and consistent with the demand and services, so which would translate into a steady returns for investors. Like right now, in reality, the tariffs have gone up. The industry has been a little bit sluggish, has a little been sluggish in terms of attractiveness for investors when it comes to issues to do with investing in the energy sector. So the government is trying to make it more stable and attractive, and the tariffs that we have been paying for a long time are heavily subsidized, such that the foreigners or foreign investors have it. So you can also actualize it in that context. Dividend policy, while the company's dividend yield may be small compared to other companies, it's relevant to consider the company's dividend policy in the context of what? Strategic management. So management may prioritize reinvesting the profits into the business to fund the expansion initiatives. Also, portfolio diversification. Investing in a company like CEC shares should provide diversification benefits to your uncle's portfolio. So by adding exposure to utility of the company, it operates independently of the economic cycle. So your uncle can reduce overall risk that could be potential. This will enhance diversification. So portfolio diversification, companies like CEC also invest in other investments. So they would want to also cushion on probable risks. And finally, capital gain advantage. Unlike dividends, which have immediate taxation, capital gain from selling shares at taxed only when the shares are sold. So your uncle will have an advantage of tax advantage by investing in this company because shares will be more attractive and for planning purposes. So the second part was actually asking us to give what? To give valid arguments for this case. So the arguments that are valid for this case would be as follows. So the argument that the cousin would not possibly have validity would be in the case that number one, your uncle income generation will seek regular cash flow. So he may be skeptical about investing in a company like this because of the low dividend. Also, the growth potential of CEC is not really guaranteed. So the potential growth of a share is not guaranteed. So there are many other investment opportunities. So the question, basically part B, was asking us that are the arguments valid in this case? So you can argue for and against if you wish. So the arguments that are presented by your cousin have some validity, but they may not fully address the concerns about how low the dividend payout of CEC is. So whilst there's potential growth, stability, and tax advantages, there are also some risks that are associated that also need to be talked about. So these are the ones I'm talking about. So since the uncle is retiring, okay, he may want to seek for something that is steady and assured. So he may be skeptical because of the low dividends. Additionally, the growth potential of the share is not guaranteed, and there may be other investment opportunities which are better than looking at investing in shares. Ultimately, the decision is based on a thorough assessment on the financial health, the growth prospects, the dividend policy that your company, your uncle's investment has, and his type of risk tolerance is also very important to argue out. So this is how this question is supposed to be argued out. Any questions or additions?
Could you please just go back to the first point?
On the arguments or part one?
Arguments.
Okay, so firstly, let's do the question. Your wealthy brother is trying to persuade your retired uncle to buy shares at Overbuild Energy Limited. He himself owns few thousands and is impressed by the steady price rise. Your uncle is skeptical because CEC pays out a very little dividend. So present arguments. What arguments is your cousin likely to give your uncle for yourself to invest? And are these arguments valid? Because the first part, we're just trying to look at the probable points that he could have given him to invest in CEC. So we say the first part is he talked about growth potential, saying Overbuild Energy has a consistent rise in stock share price. He talked about stability and reliability, that this company operates on a stable industry. In this industry has consistent demand of electricity everyone is buying. Then he could have also talked about the dividend policy, that this company reinvests its profits for the future growth. So potentially the shareholders will benefit. And lastly, he said that the arguments that this person could have said is the company diversifies its portfolio, meaning it will reduce the potential risks that would be there. So these were the key points that we argued out that he could have alluded to. That's part one. Then part two, we asked now, what are some of the arguments that you could use also? So you could also refute those arguments by saying, okay, growth potential and stability are not always guaranteed, and dividend policy may not fully address the concerns about low dividend payout. Okay, then also portfolio diversification advantages are compelling, but they are not the only considerations. And finally, investments should also align with your uncle's objectives and risk tolerance. Is he a risk taker? Okay, is he risk tolerant? So these are the key issues that could have been talked about. Are we together?
Yeah, thank you.
Right. So we now go to the computation part. So remember the key topics that we're supposed to consider in this is dividend policy. What else? Working capital budgeting, portfolio, foreign trade, currency risk management. Okay, so I've discussed portfolio and dividend policy and foreign risk management. So 20, is it going to bring bond valuation? Did you talk about bond valuation?
I think it's just safe for us to go through a question. You never know. Sometimes he says you want to bring, but next you find it is there.
Okay, so let's look at this question. I only have 2 minutes with you. What is corporate governance, and discuss the importance of managing corporations, 10 marks. So basically, corporate governance refers to what? Systems, rules, and practices, processes by which companies are directed, controlled, and managed. So corporate governance is basically about balancing the interests of various stakeholders like the shareholders, management, employees, customers, suppliers, and the community. That is what corporate governance is all about. Can I repeat that? So I said corporate governance is about what? Looking after the needs of the following, the stakeholders. Okay. So corporate governance is basically about a system of rules and practices and processes by which a company is directed, controlled, and managed. It involves balancing up the needs of various stakeholders like the shareholders, management, employees, customers, suppliers, and the community. Now, what is the importance of corporate governance? Why is it important? Why is there a need? That was about how many marks? 10 marks. So corporate governance is important for many reasons. Let's look at the reasons corporate governance is important. So number one, accountability. So corporate governance will ensure companies are accountable to their shareholders and stakeholders by providing transparent decision-making processes through financial reporting, performance evaluation, also protecting the interests of the shareholders in terms of shareholder rights. So corporate governance will provide a framework to safeguard the rights of the shareholders, including the right to participate as key decision makers who are the owners of the businesses. Also to elect what? The board of directors. These ones will receive relevant information. Also exercise of control over management actions. So this will help to prevent abuses of power. Corporate governance is also important in terms of effective risk management because corporate governance practices will promote effective risk management by establishing clear policies and procedures for identifying and assessing and mitigating potential risks. Corporate governance is also important for strategic decision making. So it is important because it establishes frameworks that will facilitate strategic decision making. So it also ensures there's compliance and ethical standards. So corporate governance promotes compliance with legal and regulatory requirements as well as ethical standards. Finally, corporate governance ensures there's what? Value creation. So through corporate governance, it will contribute to value creation for shareholders. Are we together? So this is how this question with the 10 marks could be answered. Any additions? Anything that I've left out? Any questions? So let's go to valuation of the bond. Valuation of a bond. So we are told to Alicia company has issued a bond with face value 100, which pays coupon interest of 6% semi-annually. It yields similar bonds, currently 8%. Maturity period is 8 years time. What is the value of each bond? Okay, what is the value of the semi-annual bond? So we know that the value of the bond is given by coupon value, present value, annuity factor, plus maturity value, present value, interest factor. So we're given two rates usually. There's a coupon interest. For instance, if you're, in this case, you're given a coupon interest of how much? 8%. Coupon interest 6%. So this is a coupon interest 6%. The small I is coupon interest 6%. Okay, the big I is market rate. Okay, 6%. The market rate here is what? 8%. Whenever the coupon rate is smaller than the market rate, it's called a discount bond. Whenever the coupon rate is equal to the market rate, is called a par bond. Whenever the coupon rate is smaller than the market rate, it's called a discount bond. So this is a discount bond already. The time we already have is what? 10 years. Then the face value is what? 100 kwacha. We are being asked to calculate the value of each bond. Okay, it's a semi-annual bond. So semi means what? And it's 2. All right. So let's go. What are we given? Face value. So 6% is our coupon interest. So since it's semi-annual, we divide it by 2. So this is 4%. Okay. So capital I is simply small I times the face value or the maturity value. The maturity value is 100 kwacha in this case. So 4% of 100 kwacha is what? It's 4. So here we're going to put 4, value of the bond. I is 4. Then the market rate was what percent? 8%, all right? So since it's semi-annual, we have to divide by 2. Oh, here 6 divided by 2 does not 4%, but 3%. And 3% times 100 is 3 quarters. Are we following so far?
Yes, yes.
Then here we divide this by 2, it is 4%. 4%. So our time was 10 years. So since it's compounded semi-annually, the time will multiply by 2. So this period is 20. So the job of the market rate is to calculate the interest factor. So we have to start, if you don't want to use the tables, the interest factor is simply given by what? 1 over 1 plus R to the power time. Okay, so here we're going to have 1.04 to the power 20. Can somebody calculate for me?
Zero 0.456.
What's the answer?
0.456.
So to find our interest factor is 1 over 1 plus r to the power time. So to the power 20, we get 0.456. Then find the annuity factor is 1 minus PVF over r. So what are we getting? What are you getting?
.6.
Pardon? No, 1
13.
that equals then
1 minus
0.456. You press equals, then that's don't do it direct. That triggers.
okay, let me do it.
The rest are we solving? What are we getting?
13.6.
13.6.
13.6.
So how do you find the value of the bond? I times what? Present value, annuity plus maturity value times present value factor. What was our I? 3/4. Our annuity factor, 13.6. Our face value, 100. Our interest factor, 0.456. Give me the answer.
.4.
86 point what? 0.4.
4.
Yeah. So this is the value of the bond. Then what is the current yield? It's I over what? Value of the bond times 100. So 3 over 86.4 times 100. What's the current yield? What's the current yield?
3.47.
Pardon?
3.47.
3.47. So this is how easy I could simplify calculating the value of the bond. Okay. What is the effective annual rate? Who remembers the formula for the effective annual rate? Effective annual rate is given by what? EAR will be what? 1 plus R over M, M minus 1. Okay. When, what is our R? The market rate of what? 8%, so 0.08. Number of compounding semi-annually 2 minus 1. So calculate the effective annual rate. So this is simply 1.04 squared minus 1. What are we getting? 4 point what percent? It's not 4 point some, it's 8 point what? 8.16. This class is not participative. Okay, that's how we find our coupon, our effective annual rate, 8.16. Okay. So 3 plus 3, 6 marks. And finally, 9 marks are being asked. Somebody approached you for advice and is setting up a business. Explain the 3 forms of business setups. For each of them, mention the setbacks and advantages. So conclude with that one, and we can call it a day. So we have a sole trader. A sole trader has the following benefits and disadvantages. Number 1, we know that a sole trader is easy to set up. There's complete control. The owner has full control on decision making. There's direct retention of profits. The owner all the profits. Its advantage, unlimited liability. The owner is personally liable over its debts. There's limited access to capital. So proprietor may face challenges in accessing external funding. There's lack of continuity because the business is tied up with the owner, and so continuity is disrupted in the event of an illness. We go to another. We have partnership. Partnership is another kind of business. Under partnership, these are the following. Number 1, the shared decision-making and workload. Number 2, there's access to additional capital compared to sole trader because partners will pool in their capital. Then other advantages, tax burdens. Partners are levied at an individual level to avoiding double taxation of the partnership. Drawbacks is unlimited liability. The general partners are also fined of their personal assets. There's potential for conflicts once the disagreements may affect the business. There's shared profits. Decision-making partners can share profits and decision-making authorities. So this may lead to disagreement and conflicts. Other business is a corporation. A corporation has the following advantages and disadvantages. Okay, so it has limited liability, meaning the personal assets are protected from debt. Access to capital markets, because corporations can raise huge sums of money through the stock exchange. There's perpetual existence. A person can die, but it still continue. Drawbacks that is complex, costly, does potential for agency problems where there's separation of ownership and management. So this can lead to agency problems. This brings me the concept of agency problem. What is agency problem? What is involved? So agency problems basically refers to the conflicts between the principals, who are the shareholders, and the agents, who are the managers or executives who act on their behalf. That is basically what the agency problem is all about. So agency problem basically looks at what? The differences, problem that arises between you harmonizing the interests of the shareholders and your interests as a manager of a business. So there are key points you need to know. Number one, the agency problem arises when the principal hires an agent who is a manager on their behalf, but this agent has interests diverted from the principal. There's an aspect of separation of what? Of ownership and control in large corporations. So shareholders are the owners, but they delegate control as a corporate governance norm. The decision making is given to managers to run their daily routine businesses. So there are conflicting objectives here. The shareholders want to seek to maximize their wealth. On the other hand, managers want to maximize their also main aim of compensation, job security. So there's information asymmetry, where managers will often possess more information about the company, the performance, and the prospects than the shareholder. So this information asymmetry will lead them to be in an opportunistic area of behavior. So the managers in advance will want to advance their what? Their interests. So this brings in what we call the agency problem. So this agency problem will lead to agency costs, which include monitoring, enforcement, ensuring that shareholders, ensure that managers act in the best interest. So these costs include auditing expenses, executive compensation, and legal fees. So the costs are inevitable because we want to have an independent audit to ensure that these managers are managing on our behalf appropriately. The aspect of moral hazards come in when agents have incentives to take risks and shrink the responsibility because they do not fear consequences of their full actions. So there's a corporate context where managers may engage in risky, value-destroying behaviors that may perceive the costs that will be borne by shareholders. It's called the moral hazard. Sometimes the shareholders will bear the risk of the harsh decisions that managers will make on their behalf in the name of acting in the best interest of the business. So these may now bring in these issues of adverse selection, where principals now are unable to fully assess the qualifications, abilities, or motivations of these agents in terms of entering these contractual obligations. So adverse selection is a key issue that will lead to selecting agents who are not aligned to the principal's interests. So the agents may also engage in opportunistic behaviors like self-enrichment, insider trading, pursuing personal interests at the expense of shareholders. So this behavior can erode the value and undermine trust. So before you realize it, they are getting gain, buying shares and becoming shareholders elsewhere. So there are various mechanisms that could be employed to mitigate the agency problem. These could include engaging executive compensation contracts, okay, and having a board oversight, and also shareholder activism, where shareholders will sit down to regulate the requirements and market disciplines, not only in their company, but in companies across the board. Executive compensation is one of the packages that are designed to align the interests of managers to those of shareholders by linking a certain pay performance for them managing appropriately. You know, when you pay an employee well, they'll take care of your issues very well. All right. So these are some of the key issues that I thought I could make mention when it comes to the urgency problem. I hope it simplifies your work to a very greater extent. Thank you so much for your time. The physical classes are ongoing now. We started at 07. Any questions or concerns? Any questions or concerns?